Invest in what you understand. Peter Lynch's most iconic lesson, invest in what you understand, revolutionized the way ordinary people approach the stock market. While Wall Street analysts buried themselves in complicated spreadsheets and theoretical predictions, Lynch believed the greatest insights often belonged to everyday consumers who simply paid attention to their surroundings. According to him, the average person walking through a shopping mall could spot winning trends long before the financial world even woke up to them. Imagine this. You walk into a store on a random Tuesday afternoon and it's packed wall to wall with customers. Shelves are empty, employees are rushing, and new shipments arrive before the old ones are even stocked. Most people would think, wow, this place is doing well. But to Peter Lynch, this wasn't just a casual observation. It was the spark of a potential 10-bagger, a stock that could multiply tenfold. Lynch believed the best investment opportunities were hidden in plain sight. When he managed the Magellan Fund, he would frequently visit supermarkets, hardware stores, restaurants, and even talk to teenagers about their favorite brands. If a product captured the public's enthusiasm, Lynch saw it as a clue worth investigating. He famously discovered several major winners simply by paying attention to everyday life, long before Wall Street analysts published their reports. He encouraged investors to act like detectives. Why are people suddenly talking about this new brand? Why is this cafe always full while its competitors are empty? Why are children obsessed with this particular product? These everyday signals, he believed, were much more powerful than abstract theories. Lynch often joked that an observant shopper could outperform a genius economist simply by noticing what was flying off the shelves. He also understood the emotional thrill of discovering a company early, before the crowd. The excitement of realizing you spotted something real, something growing, something authentic, while the rest of the market was still asleep. This aha moment is what he wanted every investor to experience. The adrenaline of identifying a gem using nothing more than common sense and curiosity. But Lynch didn't stop there. He warned that recognizing a great company is only half the job. The next step is understanding why the business works. What makes it unique? Why do consumers love it? Does it have strong fundamentals behind the hype? His philosophy wasn't about guessing. It was about combining real-world observation with thoughtful analysis. In a world where people often overcomplicate investing, Lynch reminded us that the simplest insights can be the most powerful. The world is constantly whispering clues through products, crowds, conversations, and trends. Investors only need to open their eyes, know the business, not the stock price. Peter Lynch believed that every stock has a story, and too many investors focus on the wrong part of that story. Instead of obsessing over charts, candles, rumors, and rapid price fluctuations, he argued that the true key to long-term success lies in understanding the business behind the stock, not the daily noise surrounding its price. To Lynch, the stock market often behaves like a dramatic theater. Prices jump wildly, driven by fear one day and euphoria the next. Investors panic, celebrate, then panic again. Yet behind the curtain, far from the chaos, the real engine of value hums quietly, the company's business fundamentals. He believed that while the crowd was busy staring at the scoreboard, the wise investor should be studying the game itself. He loved companies with a clear story, a strong product, a growing customer base, a proven competitive advantage, and a leadership team that actually knew how to build something meaningful. To discover such companies, Lynch dug deep into business models like a detective solving a mystery. He read annual reports line by line, visited company headquarters, spoke to managers, and even walked through factory floors to observe operations firsthand. He urged investors to ask deeper questions. How does this company actually make money? What problem does it solve better than anyone else? Is its customer base expanding? Is management talented, honest, and disciplined? Does the company have room to grow for the next 5 or 10 years? According to Lynch, price movements meant almost nothing without context. A stock dropping 20% didn't automatically mean trouble. It might simply be a temporary overreaction. Conversely, a soaring price didn't guarantee safety. It might be a bubble waiting to burst. He compared judging companies based only on price to choosing a book by reading one random sentence. Without understanding the full narrative, you're just guessing. And guessing, he warned, is a dangerous game in the world of investing. One of Lynch's boldest insights was that earnings drive everything. Over the long term, stock prices inevitably reflect a company's ability to generate profit. If earnings grow consistently, the stock follows. If earnings collapse, no amount of hype can save it. He found beauty in this simplicity. The market may behave irrationally for months or even years, but eventually the truth always comes out. This is why he remained calm when others panicked. While the market screamed and headlines predicted disaster, Lynch focused on numbers, products, customers, and management decisions. To him, understanding the business created clarity, and clarity created confidence. His message is a timeless reminder: if you want to build real wealth, don't just watch the price. Understand the company, understand the story, understand the engine that creates value. Because in the end, the business is what wins, not the noise. Patience creates wealth. For Peter Lynch, patience wasn't just a virtue. It was the secret weapon that separated ordinary investors from extraordinary ones. He believed that the stock market rewards those who can wait long enough for greatness to unfold and punishes those who chase quick profits, reacting to every rumor, every dip, every headline. To Lynch, the true magic of investing didn't happen in days or weeks. It happened in years. He often reminded investors that the world's most successful companies didn't become giants overnight. They grew brick by brick, decision by decision, quarter by quarter, until one day their value became impossible to ignore. And yet so many investors miss out on this growth simply because they lack the patience to stay through the slow, quiet, often boring early chapters of the story. Lynch loved telling the stories behind his legendary 10-baggers, stocks that rose tenfold or more. Some of these companies struggled in their early years, experiencing setbacks, layoffs, or market pessimism. Their stock prices dipped, sometimes sharply. But underneath the surface, the companies continued improving, refining products, expanding markets, strengthening distribution channels, and gaining loyal customers. To the impatient investor, these dips were signals to sell. To Lynch, they were opportunities. He believed that enduring temporary volatility was the price investors paid for extraordinary long-term gains. A company's stock might fall 30% in a bad year, only to climb 300% in the years that followed. But most investors never saw the 300% because they ran away during the 30. Lynch often compared investing to planting a tree. You can't plant a seed, look at it every hour, and panic when it doesn't grow instantly. You water it, you protect it, you trust the process, and slowly, almost invisibly at first, it becomes something strong and valuable. That is how true wealth is built, quietly, steadily, and patiently. He also understood the emotional challenge behind patience. Watching a stock fall can feel like watching your confidence dissolve. But Lynch insisted that if the business fundamentals remain strong, then patience is not just bravery. It is rational, strategic, and immensely profitable. He warned that the real danger wasn't market volatility. It was emotional volatility. The fear of missing out, the fear of losing money, the fear of being wrong. These fears push investors into impulsive decisions, buying high, selling low, abandoning long-term plans to chase short-term excitement. Lynch wanted investors to rise above that noise. Because patience, he said, doesn't just create wealth, it multiplies it. It transforms good decisions into great outcomes and great opportunities into life-changing ones. In the end, his message was simple. Hold on to the winners, ignore the panic, and give time the space to work its quiet, unstoppable magic. You don't need to predict the market. Peter Lynch believed that trying to predict the stock market was like trying to predict the weather in a city that changes climate every 5 minutes. Entertaining, maybe, but ultimately pointless. He watched countless investors waste precious time trying to guess when the market would rise or crash, as if they possessed a crystal ball capable of seeing the future. In Lynch's eyes, this obsession wasn't just foolish, it was dangerous. To him, the stock market was a grand stage filled with noise, drama, and endless speculation. Every day, headlines screamed about recessions, booms, crises, bubbles, and global threats. Commentators made bold predictions with the confidence of prophets, but the truth Lynch understood and wanted others to learn was simple. No one knows what will happen next. Not economists, not strategists, not even the greatest investors alive. He loved to point out that the market had predicted 9 of the last 5 recessions, an ironic reminder of how consistently wrong forecasters could be. Instead of trying to outsmart the unpredictable, Lynch chose to focus on what he could understand: companies, products, earnings, and long-term potential. His approach was almost rebellious. While others panicked over fear-driven news cycles or rushed to buy during hype, Lynch calmly analyzed businesses one at a time. If the fundamentals were strong and the valuation reasonable, he bought. If they deteriorated, he sold. The rest, the noise, the fear, the excitement, he ignored. He recalled many moments during his career when investors flooded him with dramatic questions. Is the market about to crash? Is this the top? Should we sell everything? Lynch often smiled at these questions. He knew that even if someone correctly predicted a crash once, they wouldn't be able to repeat the feat consistently. One correct guess didn't make a strategy. It made a coincidence. In fact, Lynch argued that far more money was lost by people preparing for corrections than by the corrections themselves. Fear, not failure, was the true enemy of investors. He encouraged people to think long-term. Great fortunes were rarely made by jumping in and out of the market like a gambler switching tables. They were made by identifying strong companies and letting time compound those investments, regardless of market noise. Lynch's philosophy was empowering. You don't need to be a prophet. You don't need to guess the future. You just need to stay calm, stay focused, and stay grounded in reality. Because the truth is, markets rise and fall, but disciplined investors rise above the chaos. His final message echoed like a challenge to the impatient world. Stop predicting the market, start understanding it. Mistakes are normal. Discipline is power. Among Peter Lynch's greatest strengths was his willingness to embrace something most investors fear: being wrong. He openly admitted that many of his investment decisions didn't work out, that he misjudged companies, misunderstood markets, and occasionally failed to anticipate major shifts. Yet despite these mistakes, he became one of the most successful fund managers in history. How? Because Lynch understood a powerful truth. You don't need to be right all the time. You just need to be disciplined when you are right. To Lynch, mistakes were not signs of failure but signs of progress. Every poor investment taught him something new about business models, human psychology, or market behavior. Instead of hiding from his errors, he studied them. Instead of denying them, he dissected them. He knew that growth comes not from perfection, but from awareness. He often joked that a baseball player who hits the ball 3 times out of 10 is considered a superstar. So why should investors panic when only a portion of their picks succeed? In fact, Lynch's philosophy was almost liberating. Some stocks will disappoint you, some will stagnate, some will fall dramatically. But a single 10-bagger, a stock that rises tenfold, can make up for all those failures and still leave you far ahead. This understanding gave Lynch an emotional advantage. While others panicked during downturns or beat themselves up over small losses, Lynch maintained calm. His discipline allowed him to hold on to winners long enough for them to transform into extraordinary successes. But discipline wasn't just about holding. It was also about avoiding emotional traps. He warned about the danger of diversification, buying too many stocks just to feel safe. To him, a portfolio overloaded with random picks resembled a zoo full of unrelated animals, impossible to manage or understand. Instead, he urged investors to focus on companies they truly believed in and to follow them closely. He also stressed the importance of making decisions based on facts rather than fear. When a stock drops, the natural reaction is panic. Lynch encouraged the opposite response: investigate. Why did it fall? Did earnings decline? Did something fundamentally change? Or is this simply the market reacting to short-term noise? If the business remained strong, Lynch saw no reason to run. At the heart of his philosophy was a simple but powerful form of mental toughness. Discipline is not rigidness, it is clarity. It is the ability to stick to your principles when the market tries to shake you. It is the courage to let go of bad investments quickly and to hold on to good ones fearlessly. Lynch believed that successful investing is not just about intelligence, it is about emotional stability. It is about staying rational when everyone else is losing their heads. It is about accepting imperfections, learning continuously, and acting with conviction. In the end, Lynch left investors with a timeless truth. You will make mistakes, you will be wrong. But if you stay disciplined, focused, and humble, you will still win, and win big.